Rahim. This video solves an exercise that explains the difference between income flows and cash flows and explores how they are connected to net income and cash flows from operations. It shows that income flows refer to the revenue a company recognizes which may not reflect actual cash received. Cash flows track the real cash movement, including cash inflows and outflows. Net income is the profit a company reports after all expenses, but it may differ from actual cash flow due to non cash adjustments like depreciation. This exercise will help viewers to understand the key distinctions and relationships between these financial concepts. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. I would advise my viewers to check out the previous video for a solid conceptual understanding of income flows and cash flows. Having a good grasp of the concepts from that video will make it much easier to understand the content of this one. The statement of cash flows shows why cash has changed during a period. It reflects how changes in non-cash balance sheet items affect cash. Increase in non-cash assets like acquiring assets reduce cash, while decrease in non-cash assets like selling assets increase cash. Look into the balance sheet of Footloose Shoe Store. It reports the following equalities. We have the balance sheet for year number 1 and year number 2, and we have split the total assets for year number 1 and 2 into cash and non-cash accounts. So we have 138, and that is over here, and in year number 2 it is 12,595, and the same is the case over here. We have the liabilities for year number 1 as 105, and for year number 2 it is 85,032. The stockholder equity is 4440, and for year number 2 it is 57,074. Now if we look into the change in year number 2, you can see there is a decrease. This sign is for the change, so that there is a decrease in cash for 1,103. The non-cash assets have also decreased by 2,625. Liabilities have decreased by 20,362, and there is an increase in the stockholders equity. So to link the balance sheet changes to the cash flow statement, we have divided the non-cash assets and liabilities into two groups. Working capital, that is the short-term assets like accounts receivables and inventories, and short-term liabilities like accounts payable. So you can see we have the working capital liabilities, and then we have the non-cash assets as working capital as well. Then we have divided the other component, that is the other component. This includes the long-term assets like property and investment, and long-term liabilities like debt. So we have the net working capital, the non-cash assets over here, and for the liabilities are also. So if you look over here, the change in the liabilities and the non-cash working capital, we classify them, or we are going to group them under the heading of components of operating activities, while non-cash net working capital will qualify under the heading of components of investment activities, and liabilities, net working capital, and the stockholder equity will be grouped under components of financing activities. When we are preparing a cash flow statement, changes in the assets are treated as increase in assets. They indicate cash has been used, so it is going to be subtracted. A decrease in the assets indicate there is a increase in cash, so it has to be added. So when preparing a cash flow statement, changes in the liabilities are treated as if the liabilities are going to increase, we are going to add, as it means cash is provided. While a decrease in the liabilities, we are going to subtract as cash has been used. Now these adjustments ensure that the cash flow statement properly reflects cash movements related to changes in liabilities. When preparing a cash flow statement, changes in the capital, that is equity account like common stock, additional paid in capital and retained earnings, they are going to be treated like this. Like if there is an increase in the capital, we are going to add, as cash is provided from financing activities. Decrease in capital is going to be subtracted as cash is used for financing activities. Net income is to be added to operating activities, and dividends are going to be subtracted from financing activities. So these adjustments are going to ensure that changes in capital are accurately reflected in the cash flow statement, particularly under financing activities. So let us look into the exercise, um, and we are going to. So we have the this Nojiri Pharmaceutical Industries Motors. We have the balance sheet, and this balance sheet is for a period of 4 years. At the same time, we have the income statement as well, and this is for the period of year number 2, year number 3, and year number 4. We are required to prepare a worksheet for the preparation of a statement of cash flow for Nojiri Pharmaceuticals Industries for each of the years ending March 31st, year 2 to year 4. So we have to make it for year number 2, 3, and 4. Notes to the financial statements indicate the following. Number 1, the changes in accumulated other comprehensive income relate to revaluations of investments in securities to market values. The remaining changes in investments in securities result from purchases and sales. Assume that the sales occurred at no gain or no loss. So I would like to talk a bit about the accumulated other comprehensive income, and you can see this is in the balance sheet over here as accumulated other comprehensive income. Now this OCI is recorded in the equity section, as you can see, of the balance sheet, and this includes items like accounts like foreign currency translation adjustments, unrealized gains or losses on available for sale securities, and pension liability adjustments. However, since OCI does not involve cash transaction, it is not included in the cash flow statement directly. Now, since OCI itself doesn't directly impact the cash flow statement, but its realized portions may indirectly affect cash flow when related transactions occur, and it is shown in the equity section, and that's why we are going to look into that. Now, since it is shown in the equity, so we will see how to treat it while preparing the cash flow statement. We'll see how to make those adjustments. We go to number 2, no sales of property, plant and equipment. So we have the property, plant and equipment over here. And equipment took place during the 3-year period. Now, when no sales of property, plant and equipment occurred during the 3 years, so the cash flow statement reflect no inflows from the sale of assets, depreciation adjustments in operating activities, and any capital expenditures for new property, plant and equipment in the investment activity sections. Then we go to number 3, the changes in other non-current assets. So we can see we have the other assets over here. So when preparing the cash flow statement, the changes in the non-current assets are they are going to be treated as part of the investing activities, because these assets typically involve long-term investments. So increase in the non-current assets in other non-current assets is a cash outflow in investing activities, and a decrease in the other non-current assets is a cash inflow in investing activities. So non-cash changes exclude from the cash flow statement, and this treatment ensures that the cash flow statement accurately reflects the cash movements related to long-term investments or other non-current assets. We move on to number 4, the changes in the employee retirement benefits. Now, we have the employee retirement benefits over here, and when preparing the cash flow statement, changes in the employee retirement benefits, such as provisions made for retirement benefits and payments made to retired employees, are classified as operating activities because they are related to employee compensation and typically reflect the company's operating obligations. So increase in the employment retirement benefits provisions subtract from the net income in the operating activities, it is non-cash, and decrease in the employee retirement benefits is means payments. So this is the actual cash payment from cash flow in the operating activities. So by treating these changes as part of the operating activities, we ensure that the cash flow statement properly reflects the cash movements associated with employee retirement obligations. Coming to number 5, the changes in other non-current liabilities. So we have other non-current liabilities over here. So when preparing the cash flow statement, changes in other non-current liabilities are treated as part of the financing activities because they generally involve long-term obligations like long-term debt or pension liabilities. So increase in other non-current liabilities means cash inflow in financing activities, and a decrease in other non-current liabilities means cash outflow in the financing activities. So this treatment ensures that changes in long-term obligations such as debt or pension liabilities are accurately reflected in the financing section of the cash flow statement. So let us proceed. Part number B, obviously this will be, we'll talk about it when we complete part A, and also we will be talking about part C at the end of this video. So we have the information over here and we have the worksheet as is required by the question. So what you can see over here is that if there is an increase in assets, we are going to put it in brackets, while the decrease is not going to be, decrease in assets will be reflected by not putting the number in brackets. So let me explain you. You see the brackets, you can see is a negative sign, and in bracket it means that there is a cash outflow or a reduction in cash. So when you show an increase in assets, it is recorded as the negative adjustment to reflect that cash has been tied up to those assets, reducing the overall cash flow. So increase in asset means use of cash. So that's why it is shown in bracket or a negative value. In accounting, obviously, we don't put the negative value sign, rather, we put the negative value in brackets. So, in the cash flow statement, we are going to record accordingly. Now, look at the liabilities. It is just the reverse. You can see that we are putting the decrease in liabilities in brackets, and the reason is that this indicates a cash outflow or a reduction in cash. So when liabilities decrease, it means the company has used cash to settle those obligations, which decreases the available cash. So decrease in liabilities means use of cash again. Like increase in asset means use of cash, decrease in liabilities means use of cash or the cash outflow. So it is shown in brackets or as a negative value in the cash flow statement to reflect the reduction in cash as such. So now I think I have explained a lot about the problem, and we look into from the for the balance. First of all, we will look into the balance sheet changes in year number 2. So we are going to take the values for year 1 and year 2, and you can see that in during year 2, the non-cash, we are not going to talk about cash in this at this time. We are looking into the non-cash. So so if we look into the accounts receivable, there is an increase, and the increase is for 246, and don't forget that this is to be recorded as in brackets. Increase in assets will be recorded in brackets, that is 246. Then if you look into the inventories, again there is an increase in the assets, and this increase is for 99. It is put in bracket because this is the increase in assets. Then we have deferred income taxes, and again you can see that deferred income taxes is an increase. We will put in bracket as negative 124 because the cash has been used. For the prepayments, we can see again there is a increase, and increase is going to be put in bracket as negative 6. Next, we have the investment in securities. You can see, and there is for the investment in securities, there is a decrease from 4997 to 3204. So this is going to be recorded as without a bracket. This is a decrease in the assets 1793. Then we have the property, plant and equipment, and property, plant and equipment is again increasing by 308. Accumulated depreciation, there is an increase of 1057, so we don't put it in bracket. Then we have the deferred income taxes, and deferred income taxes have also increased. So this will be put again in bracket as 987. And then there are other assets. Other assets are for 151. There is a decrease, so we don't put it in brackets. Next, we have the increase or decrease in the liabilities and the shareholders' equity. So when you look at the accounts payable, there is a there is a increase, and increase is not going to be put in bracket for the liabilities. Notes payable to banks, again there is a decrease, and decrease will be put in bracket 244. Then the current portion of long-term debt, it is just 0 over here. Then there are other current liabilities, and there is a big increase of 2214. Next we have the long-term debt, and the long-term debt, there is a decrease, and this is a liability, we put it in bracket 1660. Then we have the deferred income tax, it is 0, so we just put the value over here. Then employee retirement benefits, if you look into the employee retirement benefits, it has decreased, so we have to put it in bracket 79. Then we have the other non-current liabilities, and the other non-current liabilities are decreasing, so we are going to put it in bracket, that is 16. For the common stock, there is no change, so we just put a 0. Additional, no change in the additional paid in capital. Then we look into the retained earning. For the retained earning, there is a decrease of 1317. This is with the equity, so we put it in brackets. Then we have accumulated other comprehensive income. You can see it is decrease or increase of 659. Then we have the treasury stock, and the treasury stock again is negative or in bracket by 12. Now if we are going to add up these values together, the total is negative 495. And to verify whether this is we have made these calculations correctly or not, we have the cash over here as 495, and if you look into the difference between the cash for between year number 2 and year number 1, that is also negative 4, that is a decrease of 495, and that's why we have put these values correctly. Next we are going to allocate these values into the cash flow, that is the operating activities, investing activities, and the financing activities. So we have the accounts and notes payable, that is 246. This is an operating activity. Inventories are also a operating activity. Deferred income tax is a operating activity. Then we have the prepayments. This is also operating activity. Investment in securities is a investing activity, that is 1793. Then property, plant and equipment is also a investing activity, 308. Then we have the accumulated depreciation, this is for the operation, that is 1057. Then deferred income taxes, that is also operation, negative 987. Other assets, now other assets I have already told, this is for the investing, so this is 151. Then we have accounts payable, this is going to be a operating activity, 47. Notes payable is a financing activity. Current portion is 0, so we don't talk about that right now. Then we have other current liabilities, that is for operations, 2214. And then we have the long-term debts, and the long-term debt is a financing activity, 1660. Then we have the deferred income tax, that is 0. Then employees retirement benefits, that is again for the operation, that is 79. And then other non-current liabilities is a financing activity, that is 16, negative 0 and 0, so we just don't talk about it right now. Now look at the retained earning. Now this is something I would like to emphasize. Now if you look at the retained earning, it is negative 1317, and from this, if you look into the income statement for year number 2, the net income is negative 357. So this is going to be negative 357. This is from the operations, and the remaining balance will be the financing activity 960. Then we have the accumulated other comprehensive income, and this is an investing activity, that is 659 negative. And finally, we have the treasury stock of 12, and that is a financing activity. Now, when you make a total of this, the total for the operation is 1420. The total for the investing is 977, and for the financing it is negative 2892. And if you are going to add up these values, the total must be equal to 495. If the total is not 495, we have made some mistake in putting these values in operations, investing, or financing. Okay, so this was for the year number 2, and now we move on to year number 3. Now, when we are going to, so we will see the change in the assets and liabilities in year number 3 over year number 2. So once again, we have the accounts and notes receivable, and as you can see that there is accounts and notes receivable for the balance sheet. There is an increase, and the increase in accounts and notes receivable is 1875. Over here, sorry, this is for the 2 and 3, and this is the accounts receivable. You can see there is a decrease, and the decrease in the assets is going to be decrease in the assets will be recorded in as without bracket 1875. Then we have the inventories, and you can see for the inventories again there is a decrease, and the decrease is for 758. We don't put it in bracket. Deferred income is 244. Prepayments is 315. As you can see over here, there is a decrease. And then we have the investment in securities. There is a decrease in the investment in securities, and decrease are going to be put without a bracket, that is 848. Looking at property, plant, and equipment, there is a increase over here, so this will be put in bracket as 184. Accumulated depreciation, this will be without bracket. There is a decrease, you can see, by 2058. Deferred income taxes, you can see again now this is an increase will be put in bracket 127. Then we have the other assets as 592. There is also a increase. Now coming to the liabilities and the shareholders equity, our rule reverses. Decrease will be put in brackets. Now if you look into the accounts receivable, there is a decrease, and decrease is in brackets by 1222. Notes payables to banks, this is a increase of 549. Current portion of long term debt is 200. Then other current liabilities, there is a decrease of 3609. So this will be in bracket. Long term debt, there is a increase of 1402. Then deferred income tax, no changes. Employee retirement benefit, there is a decrease of 182. Then we have other non-current liabilities, and there is a decrease by 26. Common stock, no change. Additional paid in capital, no change. Retained earning, there is a decrease by 1859. Accumulated other comprehensive income, there is an increase of 169, and treasury stock is decreasing by 73. Now once again, if you make a total of this, the total of this will be amounting to 56. And if you look into the difference between the change in the 2 years, there is a marginal increase in cash by 56. So this calculation is correct. Next, we are going to put these changes in the operating, investing, and financing activities. We know that accounts receivable, inventories, deferred income taxes, prepayments, all these are operating activities. Investment in securities is obviously investing activity. Property, plant, and equipment is also a investing activity. Then we have accumulated depreciation. This is for the operation 2058. Deferred income tax is also operation 127. Then we have the other assets 592 in the investing activity. Then we have accounts and notes payable, that is 1222 in the operations. Then we have the notes payable to banks, that is 549. Notes payable is obviously a financing activity, 549. Then we have current portion of long-term debt financing, that is 200. Then other current liabilities is the operation, so that is 3 minus 3609. Then we have the long-term debt, that is financing 1402. Deferred we don't talk about, it is 0 already there. Then employee retirement benefits is for the operations 182. Then we have other non-current liabilities, that is negative 26. Then this common stock, additional paid in capital is 0. Then retained earning. Now once again, look over here. In the year number 3 in the income statement, the net income is negative 1088. So we put this as negative 1088, and the remaining amount is 771. This is the financing activity. Then accumulated other comprehensive is the investing activity 169. And then we have the treasury stock, this is financing, that is negative 73. Now we make a total. The total is 1466, and this is 241, and this is 1281. And if you make the total again of these three as we have done before, the total must be equal to 56. And if it is not, then there is a mistake. So this is negative 1466. So now if you make the total will be 56. Okay, so now let us move on to year number 4. And for year number 4 we are going to see the change over year number 3, how the changes have taken place. So once again, you look into the accounts receivable, it will be, there is an increase of 1175. Inventories, there is a decrease of 255. Deferred income tax, there is an increase of 163. Prepayment, decrease of 107. Investment, decrease of 953. Then we have property, plant, and equipment, that is 282, and there is a increase. Accumulated depreciation is decreasing by 1777. Deferred income taxes are increasing by 1372. Then other assets, they are increasing by 647. So this will be in brackets. Coming to accounts payable, again you see that if the liabilities decrease, we put them in bracket. There is an increase in accounts payable over here by 458. Then we have the notes payable to banks, and there is a increase by 32. Current portion of long-term debt is decreasing by 100. Other current liabilities is increasing by 1030. Then we have the long-term debt that is increasing by 251. Then we have the deferred income taxes 3361. There is a increase. Then employees retirement benefits are decreasing by 96. And then we have the other non-current liabilities that is going to increase by 1. Common stock and the additional paid in capital, there is no change. For the retained earning, there is a decrease of 2659. Then accumulated other comprehensive income, you can see that there is a increase of 148. And then the treasury stock, there is a decrease of 839. So we are going to put it in bracket. Okay. Now once again we are going to make the total, and if we make the total is 1664. So now we can compare this number. We can compare this number with the relative increase in the cash, and you can see the relative increase in the cash is 1664, and that's why this calculation is correct. Next we are going to put these values in the operation, investing and financing. So we have accounts and notes payable as negative 1175. There is an increase. 255 is a decrease. 163 is increase. 107 is also increase. All these are operating activities. Investments, there is a increase by 953. Then we have the property, plant and equipment 282 increase. Then accumulated depreciation is an operating activity 1777. Then we have deferred income tax 1372. Other assets is 647. Then accounts payable is 458. Then we have the notes payable to banks, and that is financing activity 32. Current portion of long-term debt is again a financing activity 100. Then we have other current liabilities 1030, operating activity. Long-term debt is again financing 251. Then we have deferred income tax, and deferred is for the operation, that is 3361. Then we have other non-current liabilities and non-current liability employment retirement benefit, that is 96, and this is for the operations. Then we have the other non-current liabilities, that is 1, financing activity. Common stock is 0. Additional paid in capital is 0. Then we have the retained earning. We go through the same step. You can see that the net income is negative 1872. This is for the operation 1872, and the remaining balance is the financing activity, that is 787. Then we have the accumulated other comprehensive income. This is an investing activity 148. And then finally the treasury stock, the financing activity 839. And obviously this will be in bracket. So we make the total. and the total will be 4840. This will be negative 1734, and this will be negative 1442. So if we make the total again of these three, operating activity, total, operating, investing and financing, it must be 1664, as and if it is the same, we have made the calculations correctly. So this is how we complete the first part, where they have asked us to prepare the worksheet for the year number 2, 3 and 4. And now we move on to part B, that is prepare a comparative. So we are going to prepare a comparative statement of the cash flows for the year number 2, 3 and 4. And we can see here that, so I have simply taken the table for first of all for year number 2, and all the information that is here in year number 2. This is for year number 2. We are simply putting it over here. The same values are here, and now we are going to club them for the statement of cash flows. Now if you look at the now we start with the net income or the loss, and as you can see, for year number 2, the net income or loss, there is a loss of 357, so we just put it like that. Then we have the depreciation, and depreciation is how much? Is 1057. Then we have the deferred income taxes, and the deferred income taxes are how much? Now if you look over here, we have the deferred income taxes of negative 124, and you also have the liability for deferred there is no liability. Oh yes, here we have the deferred income taxes, and we have the deferred income taxes over here as well, 987. So we add up the two together, and this will be again negative 1111. Looking at the employee retirement is 79. Then we have the increase in the accounts receivable. Increase in accounts receivable is 246. Then we have the increase or decrease in the inventories, and that is 99 in brackets. Then increase or decrease in the prepayments. So if you look into the prepayments, it is negative 6. Don't forget that we are preparing this for the operation, so we will take only the operation in the first section. Then we have the increase and decrease in the accounts payable of 47. Then we have the increase or decrease in the other current assets, that is 2214. And I think we have covered all of them, because the others are going to be either for investing and financing. We will look into it in a while. Okay. So if we make the total now, so the total will be 1420. Okay. Next we go for the investing activities. And when we look into the investing activities, we have how much for the investing activities? First of all, acquisition of property, plant and equipment, that is 308 in brackets. Then look at the acquisition or the sale of investment in securities. Now we have 1793, and we also have the acquisition of other comprehensive income of 659. So when you add them together, this will be 1134, because this is a negative value we have to subtract. Then we have the other financing, that is 151, and we are going to add this up again, and if you add this up, this will be 977. Okay. Next, we go for the increase in the for the financing activities, and for the financing, we have the notes payable in the banks, short term debt, that is negative 244, and then we have the increase or decrease in the long term debt, that is negative 1660. Then we have the dividends. Now for the dividends, you can see we have 960. This is in negative again. Then we have the reacquisition of the treasury stock, and that is for 12 in brackets. Then we have the other financing transactions, and the other financing transactions is 16 in brackets again. So we make up a total of this, and the total is 2892. Okay. So we are going to add up these three: operating activities, investing activities, and financing activities. And if you add them up together, this will be negative 495. So if this is what if you can recall, this is what we have over here as negative 4. We have this as negative 495, and we have put the values correctly. Number one, 495. Now we are going to add the cash balance at the beginning of the year. Now this is for year number 2, but if you look into the question over here, for the cash year, the ending balance of year number 1 is the beginning balance for year number 2, that is 5008. So we are going to put this over here as 5008. We make the total, and the total is 4513. Now this is the ending cash balance for year number 2. And to verify whether this is right or not, look into the balance sheet for year number 2, and you can see that the cash is 4513. That means we have done our calculations correctly. Okay, man. So next we are going to go for, so this is how we prepare a comparative statement of cash flow for year number 2. We have done for year number 2, and so I have simply copied these values over here, and now we go for year number 3. Now for year number 3, once again you can see that the net income is 1088 negative, so we simply put this over here, negative 1088. And then we follow the same process. We have the depreciation of 2058 in the operations. We are preparing the operation section now. Then we have the after that we have the deferred income taxes, and the deferred income taxes are how much. So again you can see we have negative 244, and deferred income taxes are negative 127. So we sum up, this will be negative 371. Then we move on to the employee retirement benefits, and the employee retirement benefits are 182 in brackets again. Then increase or decrease in inventories, and that is going to be 758. account in accounts receivable. Sorry, if this is accounts receivable. So, so that is going to be how much account receivable? 1875. 1875. Then increase or decrease in the inventories 758. Then increase or decrease in the prepayments, and the prepayments is 315. Then we have the increase or decrease in the accounts payable, and accounts payable is one negative in bracket, sorry, 1222. Then increase or decrease in the other current liabilities, that is 3609. Now we add them up together, and that will be, this will be equal to negative 1466. Okay. Then we have the acquisition of property, plant, and equipment. And if you look at, this is for the investing activities. Now, property, plant, and equipment is 184 negative. Then we have the sale of investments in securities, and for sale you can see we have investment in securities 848, and then we have the sale of other accumulated other comprehensive income of 169. So we add them, and this will be 1017. Then we have the other investing transactions, and that is for 592 in brackets. So we sum up, and the total is 241. Next we go for the financing activities, and when we go for the financing activities, we look for the financing column, and here you can see increase or decrease in the short term debt, and that is 549. Next we come to the increase or decrease in long term debt, that is 1602. Then we have the dividends of 771 in brackets. Then we have the reacquisition of the treasury stock, and that is 73. And then finally we have the other financing transactions, and they are for 26 in brackets. So once again we make a total, and the total is 1281. Now when we make the total of, once again, the cash flow from operations, the cash flow from investing, and the cash flow from financing, this will be equal to 1281. Sorry, this will be equal to 50. This will be equal to 56. And once again we go to the question for the balance sheet for year number 3, and for the year number 3, when we go for the cash at the beginning, that is going to be how much? This is going to be for year we need the cash at the beginning of the year for year number 3. So the beginning cash balance for year number 3 will be the opening cash balance, ending cash balance for year number 2, and that was 4513. So we come over here, we have 4513, and when we look at the change, the cash at the end of the year number 3 will be 4569. We can look back over here for the ending cash balance for year number 3, that is 4569. Okay, now we have done this for year number 3 now, and we move on to for year number 4. Now these values are simply I have picked from the slide number 9. This is for year number 2, and for slide number 10, this is for year number 3. We move on to slide number 4, and once again we can see that we start with the net income or the net loss for year number 3 is 1872. So for we have negative 1872. Then we have the depreciation of 1777. Then we have deferred income tax of 4570, negative 96 for the retirement benefits. Then the increase in the accounts receivable, 1175, increase or decrease. Then for the inventories, 255. Then we have increase or decrease in the prepayments, that is 107 in brackets. Increase or decrease in accounts payable, that is 458. And increase or decrease in the other current liabilities, that is 1030. So we make a total, and the total is 4840. Next we move on to the investing activities, the acquisition of property, plant and equipment, that is for 282 in brackets. Then acquisition sale of securities, negative 805. Then we have other investing transactions, 647. This is negative again. So we make the total, and the total is 1734. Now don't forget that when we are talking about this 805, the acquisition or sale of equity, so we have two components over here. You can see how much is this? 805. We have the investment of 953, and then we have accumulated 148. So if you find out the difference, because this is negative and this is positive, that will be negative 805. Next we go to the financing activities. For the financing we have notes payable 32. Then we have 151, and this is the 151 is the long-term debt. Now from this 251 we have to subtract the current portion of the long-term debt. So that is equal to 151, and then we have the dividends of 787. Then we have the reacquisition of the treasury stock, and that is 839, and this is in brackets. And then finally we have the other financing transactions of 1, so we put it 1 over here. We make the total, and this is negative 1442. So if we make a total of these cash flow from operations, cash flow from investing, and cash flow from financing, the total will be, and this will be how much? This will be 1664. So this is the change in the cash, and if you can recall, this was the change in the cash. If you look for for year number 41664. And now we look at the cash at the beginning of the year number 4. So the beginning of the year will be the ending for the year number 3, that is 4569. So we have over here cash at the beginning 4569, and we add this up, this is 6233. And when you look at this value, this is the cash at the end of year number 4, and that is how it comes over here as 6233. That means we have made our calculations correctly. Okay, man. Next, we are going to prepare a, so we have prepared a so all the three, this was for year number 2, and then we have done for year number 3, and then we have done for year number 4. All these values has been placed over here to, and that is the comparative statement of cash flows for year number 2, 3 and 4. Next, we are going to go to the, for the last part over here, we have done B as well, and part C is discuss the relations among net income and cash flow from operations and the pattern of cash flows from operating, investing and financing transactions for year number 2, 3 and 4. Now, if you look at year number 2, let us first of all talk about year number 2. Now, in the year number 2, the company has reported a negative net income first of all, and although when you look at the cash flow from operations, it has generated a positive cash flow from operations. Now, this is primarily due to the strategy of stretching the payment to current creditors. You can see over here the current creditors for year number 2, 30,409, and they have also they have sold the investments in securities as well. You can see there is a decrease from year number 1. So the proceeds from these activities they have used to pay the dividends. As you can see, they have paid the dividends of 960. Now, this approach, while providing a short-term liquidity, you can see the current assets. It is raising concerns about the financial prudence, as stretching the payment to short-term creditors to meet the long-term obligations may lead to liquidity issues in the following periods, and we will show it in a minute. In addition to this, there is a significant subtraction from deferred income taxes that Nojri recognize as taxable income. I will show you. You can see the, for year number 2, the deferred income tax as 948. So they are so despite the fact that they are reporting a income tax credit because of the net loss for financial reporting purposes, it implies that the firm has to pay the income tax for the fiscal year 2, although you can see that the net income is negative. So this is, we can talk a lot about that, but these are the major things that we can look into these numbers. And let us look into year number 3. Now, if you look into year number 3, the net loss has deepened as compared to year number 2, and its cash flow from operation, they have also turned to negative from positive. Now this is mainly driven because there is a decrease in the accounts payable. You can see over here, uh, and there are, you can see in the other current liabilities as well, there is a decrease. So the firm that has a deferred payment in year number 2, this was forced to settle their obligations in year number 3, as you can see, 371. So this, exacerbates its liquidity problems. So although the company has managed to offset the negative cash flow by reducing its accounts and notes receivable, you can see they have reduced them. Accounts and notes receivable over here. And even they have, you look into the inventories, they have reduced the inventories as well. And this was obviously going to contribute positively to the operational cash flow. Now, at the same time, look at the depreciation. The depreciation has also increased. And the increase in depreciation, which is a non cash expense, this has helped as well. But the firm still continues to sell the securities. You can see over here. They continue to sell the securities. You can see from 32 to 2356. As both they are in the short term and in the long term debt to cover the operational cash shortfall. We have already talked about this. There is a shortfall in the operations, but even then, they are, when you look at the dividend, they are still paying the dividends despite its worsening financial position. So this raises the questions about the capital management and the financial strategy of the company in year number 3. Now let us move on to year number 4 and see what happens over here. Now if you look into year number 4, further you see the net income has further declined. Green is better. It has further declined, with the company reporting a larger loss. So however, the good thing is that if you look at the cash flow operations, they have now become positive. This is due to the what are the main reasons? This is due to the additional deferred income taxes. Now this indicates that the company is likely to carry forward positive taxable income from earlier years, or they have experienced a greater loss for income tax reporting than for financial reporting, and thus they are receiving a tax benefit. Now, if you look at the sales, that sales is stable over a period of time. The company is facing an increase in the accounts receivable and notes receivable. You can see over here. They are finding an increase over here between the accounts receivable and you can see over increase in accounts receivables over here. So what else should I say? In addition to that, if you look into the current liabilities for the year number 4, and there is an increase, and they are using its positive operating cash flows to purchase investments in securities, as you can see, 805 acquisition or purchase of securities. They have paid the dividends in the year number 4 as well, 787, and they have repurchased shares of its common stock also. They are continuous. I mean, there is a substantial rise in the repurchase of shares of its common stock. So the firm's ongoing dividend payments and stock repurchases, despite its significant losses, There is further concerns about its long-term financial sustainability and capital allocation priorities. So, if we summarize, so although the company is maintaining a positive working capital, you can see current assets, you can compare the current assets and the current liabilities. You can see that they have a positive working capital position with current assets exceeding the current liabilities. The company's increasing reliance on debt financing. You can see over there the long term debts, they are continuously on the rise. Decreasing equity levels, so this raises a significant concern about its financial stability. Then the persistent net loss, and that is also on the rise. And the company's ongoing decision to pay dividends, as I was telling you just now. They have been paying dividends for all the 3 years, and even there is a repurchase of its stocks. Um, Although there are financial challenges, what they suggest is that the company is facing a potential liquidity crisis. So the firm's ability to continue meeting its obligations, especially if the trend of negative net income and cash flow from operation continues, it may be in a jeopardy. So as the proportion of the liabilities in its capital structure grows, as you can see over here, uh, the company must reassess its dividend policy and stock repurchase strategy, particularly in light of its deteriorating profitability and increasing leverage as well. So, the long term viability of the firm could be at risk unless corrective actions are taken to restore operational efficiency and profitability. So this completes the video on interpreting the relations between net income and cash flow from operations. I will be uploading one more video on this topic, maybe at some later time, but definitely I have a plan to upload one more video on that. And I hope you have enjoyed this presentation. And if you found value in this video, then please like, subscribe, and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.